buckle up, because Morgan Stanley just unleashed a financial powerhouse of a third-quarter earnings report that smashed expectations and left analysts scrambling to catch up. This isn't just another routine update. It's a jaw-dropping showcase of how Wall Street's pulse is racing stronger than ever. But stick around, because while the numbers look rosy on the surface, there's a layer of intrigue beneath that might just spark some heated debates about the future of big banks in a volatile world. Imagine you're a financial giant like Morgan Stanley, and your latest quarterly results don't just meet forecasts, they obliterate them, outperforming by the widest gap in almost 5 years. That's exactly what happened on Wednesday. Thanks to red-hot performance in stock trading, deal-making advisory services, and personal wealth management. For beginners dipping their toes into the financial waters, think of this as a bank betting big on the excitement of the stock market, where buying and selling shares can be as thrilling as a high-stakes poker game. And when that excitement translates to record-breaking profits, it's a win for investors everywhere. Let's break down the highlights, shall we? Morgan Stanley reported earnings per share, a simple way to measure profit per individual share of stock, at $2.80, which blew past the $2.10 that experts had predicted, according to data from LSEG. Total revenue clocked in at a whopping $18.22 billion, surpassing the $16.7 billion estimate. To put this in perspective for newcomers, revenue is like the total income from all the bank's activities, from trading to advising companies on big deals. This quarter, profits skyrocketed by 45% year over year, hitting $4.61 billion or $2.80 per share. Revenue also climbed 18% to set a new company record at $18.22 billion. Not surprisingly, Morgan Stanley's stock price jumped nearly 5% in pre-market trading, building on a stellar year where shares have risen about 24% as of Tuesday's close. And this is the part most people miss. The backdrop fueling this boom is a Wall Street that's practically buzzing with energy. Trading floors have been buzzing with activity. Investment banks are seeing a revival in mergers and acquisitions. Think companies joining forces or going public through initial public offerings. And stock prices hovering near all-time highs have given a massive boost to Morgan Stanley's wealth management arm. For those unfamiliar, wealth management is all about helping high-net-worth individuals and families grow and protect their money through personalized advice, investments, and planning. It's like having a financial coach for life's big goals. Banks deeply tied to Wall Street, such as Morgan Stanley and its rival Goldman Sachs, are perfectly positioned in this vibrant environment. Diving deeper into the numbers. Equities trading revenue, which covers the buying and selling of stocks, leaped 35% to $4.12 billion, exceeding analyst expectations by a cool $720 million. The bank pointed to heightened engagement across different business areas and global markets, plus groundbreaking performance in its prime brokerage services that support hedge funds, those specialized investment firms that often aim for high returns through strategic bets. Fixed income trading, involving bonds and other interest-based investments, edged up 8% to $2.17 billion, aligning closely with forecasts. But here's where it gets controversial. Investment banking revenue surged 44% from the previous year to $2.11 billion, outpacing street account estimates by about $430 million. Drivers included a flurry of completed mergers, a surge in IPOs, and increased fundraising for bonds and other fixed-income products. Some might argue this resurgence signals a robust economy rebounding from past slowdowns, while others could counter that it's overly dependent on fleeting market euphoria. Is this sustainable, or are we setting up for a potential downturn if stock prices falter? Wealth management revenue, meanwhile, grew 13% to $8.23 billion, $500 million above expectations, powered by rising asset values, like the total worth of investments under management, and higher fees from transactions. It's a classic example of how when stocks perform well, people trade more and seek professional guidance to capitalize on the gains. To add context, this isn't happening in a vacuum. Just the day before, other major banks like JPMorgan Chase, Goldman Sachs, Citigroup, and Wells Fargo also released earnings that exceeded forecasts in both profits and revenue. It's a bullish trend across the industry, but does it mean we're in an era of endless prosperity? Or is there a bubble waiting to burst? This tale is still unfolding, so keep an eye out for more developments. But in the meantime, what do you think? Do you believe Morgan Stanley's success is a sign of economic strength? Or does it highlight vulnerabilities in relying so heavily on stock market highs? Share your take in the comments. Do you agree this is a cause for celebration? Or should we brace for challenges ahead? I'd love to hear your thoughts and spark a conversation about the future of finance.